Why a low credit score can have such a huge impact on your life. Hi, my name is Shane Whitted, financial advisor and certified counselor for Rock Credit Repair. Today I want to talk about credit and its worthiness, and I also want to talk about debt-to-income ratio and how the credit bureaus are scoring you. Well, first, credit itself is a mechanical formula that's based on your credit worthiness. It's how the bureaus are scoring you. But first I want to talk to you about how the credit bureaus are scoring you and how those percentages are affecting your credit scores. So think of that financial math pie that you did in math class. Let's talk about that. 35% of that pie is actually your payment history, your on-time payments, no late payments. That is a big impact of your score. It's 35% of how the bureaus score you. Capacity and amount owed. So the authorized limit you're limited on your credit card, let's say you have a $10,000 credit card, the most you'd want to have on that credit card as a balance is $2,500. That is 30% of your credit score of how the bureaus are scoring you. Length of credit would be the length of time you've had that credit line of credit open or credit card open. That's how the bureaus are scoring you, is about 15% of that financial pie. New credit would be a new line of credit card opened up, a retail bank card. If you go out and get a car loan, that's 10% of how the bureaus are scoring you. And then the final 10% would be the types of credit used. So that's utilization credit. Let's talk about utilization credit. It's always good to have at least one good credit card open, a store credit card open, a car payment open, and those are what they call utilization credit. That's types of credit used. That's 10%. So every time you go open up a new credit card, now I'm not saying go out and open up a bunch of credit cards. What I'm saying is if you don't have that many credit cards, if you go open up another credit card, keep it at a low balance, it's going to impact your score about 10% in a positive way. So it's going to go up 10% of your credit, of how the bureaus are scoring you. So again, that's how the bureaus are scoring you. This is very realistic. This is exactly how the bureaus are scoring you, is based on each category that I just explained to you. Now let's go and talk about what a low credit score can cost you and how it affects your life. Well, let's talk about person A. Person A is just a person that just doesn't have a good credit. Let's just say person A has a credit score of 599. Their interest rate they're paying is obviously going to be high, 14.99%. Their payment they pay on this vehicle is $513.97. Now let's talk about the vehicle for a second. The vehicle, let's just say it's a brand new car, $23,000, 66-month term. They're paying an interest rate again of 14.99%. Their payment monthly is $513.97. Total payments they pay on this $23,000 vehicle with the interest rate of 14.99% is $33,921.44. So the total interest they end up paying is about $10,921 on top of that $23,000 car loan. It's quite a bit. Let's go to person B. Person B's got great credit. Credit score is 730. Interest rate is 1.99%. Payment is $368.22. Total payments they pay on that $23,000 car is $24,302.39. Total interest they end up paying is $1,302.39. Now look at the difference there. $10,000 versus $1,302. That's a big difference. Just going from a $599 up to a 730 credit score is that's how much of a tremendous difference. That can affect you on a car loan, that can affect you on a house payment, that can affect you on refinancing a house, that can affect you on student loans. I mean, there's just a lot that across the board that can affect you there. So person A ends up spending $9,616.05 more on this car loan for $23,000. I hope that helps you. Please visit us at rockcreditrepairs.com. Again, that's rockcreditrepairs.com. Pay attention to our new videos that are coming out on student loans and medical debt. Thank you.